Here is a number with 48 zeros after the decimal point. 2.3 times 10 to the minus 49. That is the number that measured whether my machine had any edge at all. I scored it against reality, and the edge didn't shrink. It vanished. Not weak, dead. Then it died a second time, on different grounds. 2 deaths, 1 machine, both on the record. This is the video where the trade stops breathing. You can build something genuinely smart. A frontier model reads a market and the news and hands back a clean probability. It looks right, it sounds right, and that feeling is the trap. Smart is not the same as having an edge. Edge means beating a number thousands of motivated people already agreed on. A model can be brilliant and edgeless. Here is how you fool yourself. You compare the model's probability to the market's, see a gap, and call it an edge. But you scored the model against the market's guess, not against what actually happened. The only honest scoreboard is realized outcomes. Did the event occur? Yes or no? Score against that. And most of your gaps are noise, wearing a confident face. So I did not argue about it. I ran an experiment I could not fudge. Before I scored a single prediction, I wrote down the exact test that would count as success. Then I hashed it. That produced a fingerprint. I published the fingerprint before the evaluation data existed. You cannot move a goalpost after you have published its fingerprint. The test itself was simple. Take 540 predictions the machine had already made live in real time. Not back-tested, not curve fit on old data where I already knew the answers. Score everyone against the outcome that actually landed. Then answer one pre-committed question. As a group, did the model beat the market it bet against? Then I ran it. The number came back at 2.3 times 10 to the minus 49. In plain language, the chance an edgeless model could have thrown a result this lopsided was indistinguishable from zero. This was not a faint signal that more data might sharpen. It was signal dead, a verdict with no room left in it for maybe. Let me put that number in scale. In most of science, you call a result real when the odds of a fluke fall below 1 in 20. This result cleared that bar by dozens of orders of magnitude. Not a close call that leaned my way. It was the most decisive answer a machine has ever handed me, and it said no. I did not take that at face value. I went hunting for a surviving corner. Maybe the model was only good on its high confidence calls. It was not. Maybe only where it claimed a large edge. No. Maybe strong in one category and dead in the rest. Nowhere. Every slice I cut, the market had already priced correctly. No positive subslice survived. Not one. So why? Why was there no edge to find? Because the price already contains everything my model could read. By the time my machine finished reading a market, the crowd had finished first, and the price had already moved on it. The market integrated all of it before my machine woke up. The apparent edge was noise. The market already knew. You might think speed saves you. It does not. You are not racing the news. You are racing thousands of people who also have the news and a head start. Second place pays nothing here. There is a lesson here worth more than the whole experiment. Any model that grades its own homework looks like a genius. But that is marking the exam against an answer key it wrote itself. Score it against what actually resolved, and the brilliance evaporates. So the predictive dream is dead, provably, permanently dead, but I was not finished. There was a second way to make this pay, and it needed no crystal ball at all. When forecasting fails, every trader retreats to the same fallback, arbitrage, the strategy that is supposed to be free money. The idea forecasts nothing. 2 venues list the same event. Their prices drift apart. So you buy yes on the cheaper venue and no on the other for less than $1 combined. Whatever happens, one of those 2 sides settles at a full $1. You keep the difference. You never had to guess who wins. It is market neutral by design. On paper, it looked safe. Except the gap is thin. Where a cross-venue gap exists at all, it runs about 1.5 points. So nobody's getting rich here. You collect pennies off a mispricing most people never notice, and you have to spot it and lock both sides in the seconds before it closes. Thin and fragile. That was the good version. Then the fee arrives, and this is where it ends. Polymarket's 2026 dynamic taker fee eats about 94% of that gap. 94%. A blind taker, someone who just crosses the spread to grab the trade, walks away at a coin flip. You reach for 1.5 points and keep a rounding error. And scale does not save you. This fee is a percentage. Trade $10 or $10,000, it takes the same cut. Bigger money does not shrink it, it just loses more, faster. You can dodge that fee, post your own orders instead of taking theirs, and it mostly disappears. But now the trade breaks in half. You fill one leg and you hang on the other, exposed. waiting for a fill that might never come while the event drifts against you. That is legging risk. A fund warehouses it without blinking. It has the balance sheet to wait. But I did not have a fund. I had $406. At that size, you cannot warehouse a hanging leg. One bad hold erases a month of collected pennies. So I ran the whole menu. Directional prediction, dead. Blind taker, a coin flip, maker, fatal legging risk at my capital. Every path came out net negative. So I shut the trading down. Now the part that makes the first death a result, not a story. A p-value with 48 zeros is only a result if I could not have chosen it afterward. I could not. I froze the threshold before the data and the window with it. No flattering stretch of calendar to hide in. That fingerprint is the line between a result and a story. Without it, this is just a guy who lost money. And here is the lesson that outlives prediction markets. A small bankroll is not just smaller bets, it changes which strategies are even legal for you to run. A fund shrugs off legging and warehousing risk. At $400, it is simply fatal. Capital is not a volume knob. It is a gate on the menu of moves you are allowed. Two deaths, both on the record. Smart and having an edge are not the same thing. My model was smart. It had no edge. The predictive dream died because the market already knew at 10 to the minus 49. The arbitrage dream died because the fee ate the gap. $400 bought the difference between a loss and a result. Trading is not paused. It is buried. But killing the trade left one thing alive, a signal no single venue scraper can copy. Two venues disagreeing about the same event. I could not trade it, so I tried to sell it. At first it looked real, too real, so I built 4 agents whose only job was to disprove it. The method is written up, subscribe, and the phantom is next.